Hello and welcome to a new episode of Finance Rundown. In this episode, we are going to be talking about market to market. So what is the definition of market to market? It's a method of measuring the fair value of accounts that can fluctuate over time, such as assets and liabilities. So basically, why is the market to market or ATM method of measuring the fair value of accounts that can fluctuate over time? Because the market to market aims to provide realistic appraisal of an institution or company's current financial situation based on current market conditions. So in trading and investing, certain securities such as futures and mutual funds are also marked to market to show the current market value of these investments. So why is market to market can present a more accurate figure for current value of a company's assets based on what the company might receive in exchange for assets under current market conditions. And so the other one is what happens when it's during unfavorable or volatility times, such as what happened during COVID when everything got shut down, and so a lot of people started to take money out and the stocks plummeted because people were scared that something was going to happen. And so because of the decrease in stock prices, that's when a lot of people started to buy stocks, because they were normally, some stocks were rated like $150 or above or below, and so people felt that because a lot of share prices were so low that they could own a share of a company that they previously could not do because of the stock prices were so high. So why is an alternative? So when it's like the future trading accounts, in the future is basically what's going to be the next day, or what was the price of the stock that closed and when it was open. Because what also people don't realize is after market trading is when, even though the stock exchange in New York closes, I think around about like 5 o'clock, that's when you have considered that like 5:30 is when after market trading happens. And so the reason why that is because in other states, especially in California, is when they are pretty much getting short on their day, and so they have to trade during the day when the stock markets are closed in the US, but in other parts of the world they are open. So basically, when you're doing trading, you have to keep two things in mind: is how much profit you're going to make, but also the losses. And you also have to be in the long run. And also what people don't realize is like the short selling or the long selling. Basically, the short selling is you putting money into a stock, and if a stock goes up a couple points or a couple dollars or like a couple $100, you sell that stock at a gain. And if you are shorting a stock, means you're trying to bring that stock price down to make a profit on the company's losses. So basically, understanding market to market is the accounting practice that involves adjusting the value of an asset to reflect its value as determined by the current market conditions. So basically, I'm going to bring back my last episode, was when the Enron scandal, and they were using heavily market to market to hide their losses to make the company look more profitable, so they could use to gain more investors and also do more businesses. So because they were using this market to market idea to hide their liabilities and their big ticket liabilities, that if they had it on their books, that this company would not be as profitable. So basically, how would they get the assets that was sold at the point in time? So it's basically the stocks that were sold or the stocks that were bought in a certain amount of time. And then also after the fiscal year, a company has to do a balance sheet that has to reflect the most current market value of a certain account. So if it has to be the SEC or the New York Stock Exchange about what was the most current stock price that it closed on the last day of the fiscal year. So why is the market such used in financial services? So basically, when you're using market to market, it's basically when you're looking through companies' financial papers or the reports that they have to use, is so when the companies are making adjustments, their asset counts, in the event that some borrowers default on their loans during the year, when these loans have been identified as bad debt, then the lending company will need to mark down its assets to fair value through the use of contra assets, that is such as allowance for bad debt. So basically what allowance for bad debt is, it's basically if people are not paying their bills or credit cards on time, or if they or other companies are not paying their accounts on time. And then the other thing to keep a lookout for was that customers, in order to collect quickly on accounts receivable, this has to be marked in the AR to a lower value through the use of contra assets account. So because of all of this is what Enron was using to hide their bad debt and their debts, because they wanted to be more profitable. And also they started to do shell companies where they were basically doing fraud. So basically, and then on the personal accounting is also used to market. And since the famous replacement cost of an asset, say you, for example, when you have to do a replacement cost, it's basically is when you have to rebuild your home from scratch if there was a tornado or if there was a hurricane. So basically you have to have homeowners insurance. It is because, say, if anything happens to your home, you're covered, that it's up to a cost which they have to cover, that is what your home was originally appraised at. So when you're making sure you have homeowners insurance, you have to make sure that your home insurance, when you're reading the fine print, make sure it's okay for certain disasters. And then also what happened in Florida was, because so many places in Florida where a lot of people go to for their investment properties, or if they were having a second home, that they didn't really have certain good homeowners insurance because they were only there for half the year. And because of that, they weren't really entitled to have full homeowners insurance, but they had partial insurance, and so that because of that, it didn't really cover them for hurricanes. And so now people are trying to figure out how to help them, and also use the insurance to rebuild their houses or make adjustments or to fix the interiors of the homes. And so in the market to market is also being used into investing when you're trying to figure out the difference between in security trading, it's like market to market involves recording the price or value of a security portfolio or account to reflect the current market value rather than book value. Basically, the book value means it's the cost of the stock that you're buying on that book. So it might be like, say you're buying it for one share of, I'm going to use an example of like $25 a share. But what people don't realize is if it goes like up or down and it fluctuates, you have to use that to guess what the cost of the stock's going to be. So basically, what is being used in the future accounts that ensures margin requirements are being met. So when you're using book value, you have to make sure that the future accounts that are being protected and being met per client, and then the current market causes the margin accounts to fall below what is the required levels. And also the margin calls is basically when the margin is being used to help with. So basically, a margin call is a broker demand that an investor who has borrowed money to buy securities deposit additional funds when the equity in the account drops below the minimum value, known as the maintenance margin. So basically, the maintenance margin it's basically how much you have in your account of like investing. So especially in banks and stuff, they have like set up how much money you have to have in your checking account or savings account. That is like the lowest and minimum that you have the maintenance is like $300. I know that's at Chase Bank. So basically, what the takeaway is, the market to market in accounting, and then also what is market to market. And then the other takeaway is that market to market is also used in personal accounting and also in investing. And also we use that I also did a quick definition of what is a mutual fund and a margin call. So I hope you find this really interesting, and I hope to see you guys on my next episode of Finance Rundown. And thank you, and have a really nice rest of your day.